People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Glad you're going to spend a little time this weekend thinking a little bit about your money, because of late, you've probably been looking at your accounts and going, holy cow, what's going on here? And we will talk about that today, about how to protect your money before and in retirement. But that's just part of the show. We got a lot to go through today. Charisse, how are you doing today?
I'm doing great. I got a really great yet awful farmer's tan going because I've been doing a lot of golfing. If anybody's checked out the Zinnia Wealth Management Facebook page, you've seen some pictures of me and Urban Meyer golfing and Tim Tebow golfing.
Nice.
Yeah. So I was invited to go golf with them, and I got to play 9 holes with Urban Meyer, and then I got to play 9 holes with Tim Tebow. Which was very fun. I learned so much about both of them. I had an injury. And right off the bat, Randy, you'd be so proud of me. I could only golf with one leg. That was my strong leg, my right leg. So I couldn't swing through all the way if I tried. So my first round, I knocked it out of the park. And coach said, holy cow, you're injured and you hit it that far and that straight. I know this is the luckiest shot in the world. It won't happen again.
Actually, you should, when many of us are injured, like our back hurts or something like that, what happens is you slow down. And when you slow down, you hit the ball the way you're supposed to. So
it's crazy, but I was playing probably some of my best golf.
There you go. See, I told you.
I still got a little baby injury. So that was fun. And Timmy and I got to really get close on our 9 holes, and just great advice from him. He's like, you're the only person who takes the time when you spend time with me and asks personal questions, because I have all these big mentors. I'm like, I know I'm using my time while I can. He laughed, but it's such a fun thing. So go to Facebook. We did a tag team putt off. We both missed it. And while he was singing.
He was singing to you while you were putting?
He was singing to me, too. It was so sweet. Yeah.
All right. I love it. Well, this was the past weekend also of the Caddyshack tournament up in St. Augustine.
Yes.
And so I was at that one. And
I know.
so
I couldn't make it.
We sat down and talked to the Murray brothers again. So you're going to hear some of that tape coming up here not too long. And we got into some fun stuff about movies, but we also got into some financial advice, too. So financial advice from Bill Murray and his brothers is coming soon on the show here. So
yeah, that was a fun interview when I interviewed them a few years ago.
It is. They're fun guys. And I mean, you want to talk about guys who are not only, they're all in business as well. I mean, not only you've got Bill as an actor, but you've also got the Bill Murray clothing line.
Oh, yeah. It was just fantastic.
And then you've got the Caddyshack restaurants. And now they're doing Bushwood bourbon. And so, I mean,
I didn't know that.
Yeah, there's lots of different things that they're into. So we can speak to them from as a business owner as well as famous actors and people. So that'll be fun. So we'll have that coming up. But what most people are concerned about is the stock market right now. Holy cow. Are we bouncing all over the place? I mean, you get a little bit of up, you get a lot of down, you get a little bit more up, and back and forth
it's Groundhog's Day, right?
It is nuts. All right, so we go to some of these people on these financial networks, and this is Ed Yardeni, and you'll see him many times on Fox Business, and he thinks that we've hit the bottom, and the worst of all of this is over.
Yeah, there's plenty of things to worry about, but the market is actually holding up pretty well. I mean, we're still basically in correction territory. We got very close to bear market for the S&P 500. The NASDAQ got into a bear market for, a few days, and now we're back in correction territory. I think, Americans are great. When we're happy, we spend money. When we're depressed, we spend more. As long as there's a wherewithal, and the initial claims data show that the labor market's hanging in there remarkably well.
All right, so one of the reasons he said that at the end is that one of the signs of a recession is when the unemployment rate starts going up, and they've been watching that very closely. That's hanging in there right now. But Charisse, whenever somebody on one of these networks calls the bottom, they say, oh, it's all up from here. Do we believe that?
I don't know. Mr. Yardeni.
Yeah, I don't know.
Listen, okay, so I'm optimistic, but one big move from Trump and it all goes tumbling down.
Yeah,
right?
that's true.
One big adverse reaction, right? So I wouldn't say we're done, but I do think we will probably hit another high. We're definitely going to hit another high, and then it could probably bounce back down. But then you bounce down and hit another high. That's what the price of admission in the stock market is going down, so we get another high. That's just how it's always worked. So I will not predict. I mean, my first predictions of this correction, and we were correct about that. So we'll see what happens with like Japan and the tariffs, and what's really held back in the long run. And do we go into hyperinflation for a short amount of time? Who knows? So we're keeping our eyes on the prize for sure. But I will tell you this much. And I'm going to say it this way because there was a caller who called in a couple of weeks ago, and this is really important. He talked to one of my advisors. The advisor came and talked to me and said, Charisse, he sold 100% to cash. Should we buy back in? And so I'm going to use this terminology. Stacking habits. In pre and post retirement, you have to learn how to stack habits. Okay. When you're younger, you have to do it. When you're mid-age, you have to do it. And even in retirement, you have to do that. And when you do create new habits and you do it for a certain amount of time, it becomes a new habit. And one of the habits is when you're invested in the market, not bailing every time you get emotion, this big emotion hits because you're like, oh, I need my money, or I worked too hard for the money, and you sell to cash. Because this gentleman did not buy back into the stock market after we tried to talk him off the ledge. I said, go ahead and get back in because it's probably going to come back up. And at the end of the day, he missed the total run back up. So for him to make the 10% that he lost, who knows how far this next run up's going to go, but he missed the opportunity because he was timing it. And so here's like two questions we asked. It's a two-part question. What should you do? And what should he had done before he sold to cash? Number one, age, Randy, matters. Age matters. So if you're 30, 40, 50, 60, or 70, he's in his 70s, right? So when you're your 70s, you're in a new season of life and things change and the way you think changes. And no matter is fast growth the goal. It's preserve. And it's what I keep that means the most, right? And so that is a true statement. So age matters. So he's 70. So I can see why he did that. He did not have a financial advisor. He went in and did it on his own. So nobody could talk him off the ledge. Number two is, can you afford to lose the money and can you emotionally handle it? Right. So the question we asked to this gentleman was, well, you had $1 million and you lost $100,000. Can you afford to lose $100,000? He went, well, yes. Can you afford to lose 10%? He went, yes, but I don't like it because the big question is, I get emotional now. Now it means more to me. And I was like, well, now you're never going to be able to gain that 10% you just lost. Now you're going to start right from wherever the market's at now. So I would say, if you have $1 million and this is you probably do need to have a financial advisor in your life to help you make some of those big emotion decisions. And so I always do the math on everything, as you know, Randy. And the math equation is, if you have big emotions, check off yes. If you can not afford to lose $100,000 on $1 million, check off yes. And then what you figure out, the equation is 1 + 1 = 2. That means, hey, if you equal 2 here, you definitely probably need a financial advisor to help you look at the other alternatives out there, or things that are compounding that don't lose, because there are other things besides being 100% in the stock market. So we need to be really careful, especially the season of life we're in, or if somebody's passed away, or if you have to live on your income, that's also a whole nother season. And you really do have to be more dialed into the asset allocation in your portfolio.
You know, it's interesting. There's a lot of television shows and radio shows like this, and we know that. And what we want to do is show you how Charisse is different. And what you are going to hear during times like this, what's your risk tolerance? How much do you want to be in the market? What's your, is it 90-10? Is it 50-50? Is it 60-40? All these things. Maybe you need to ask your question like this. Do you want to be on the roller coaster at all? Maybe it's, do you want to be in the market or do you not want to be in the market? Do you want to take this ride? Because if you don't, like this guy, he doesn't like the down. If you don't like the down, maybe you don't want to be in the market. And if that's the case, let's talk through that.
Yeah. And I'll say this, Randy, you have to have confidence. You have to communicate and you have to have confidence. So when you communicate and you have confidence, it equals controlling your emotions, not doing the wrong thing at the wrong time.
Well, this next story kind of goes along with that because the people at Vanguard, it was an interesting article. The question was asked, how many people who have Vanguard holdings have bought or sold or made moves now that the market is very in flux? When they, like the guy you were talking about, the market goes way down, he sells. He goes to cash. Are people buying the dip? Are people doing that? According to this, only 8.4% of investors at Vanguard have done any trading. The buyers have outnumbered the sellers 5-1. Overall, their investors have not panicked. So let me ask that of you, Cherise. Have you had people call when the market went down, to 37 or 36,000 on the Dow, where they panicked, where they go, oh my God, Cherise, am I going to be okay? Were you getting calls like that?
No. Just because we build in communication and confidence when it comes to times like this, when the economy, it goes up, it goes down. It's a big roller coaster ride. But if we're not communicating with our clients, we're not showing that transparency that they need. If they don't see us doing something, that causes big emotions and bad decision making. So I would say most of our clients are very confident. And it's interesting that Vanguard says this. I totally, truly believe that because the people who invest in Vanguard, they're usually investing on their own and is buy and hold, and they understand the ups and downs, and they probably already have money packed away for income that they don't even need it. So I do believe that to be true survey here.
Well, a while back, and this was all the way back at COVID, I remember, we were putting commercials on the radio. And one of the commercials I remember, because I wrote it, was we were built for times like this. And I think that goes for COVID, that goes for 2008, and that goes for what we have right now. Markets are volatile. They go up, they go down. And we want to make sure that you have a plan that is built for times like this. So let's sit down together. Let's talk about it. Give us a call. Give us a look on our website. It's zinniawealth.com, ZINNIA wealth.com. And you're going to see a gold box, and it's going to say complimentary retirement consultation. If you click on that, we'll ask you a little information there so our team can reach out to you. And let's start the conversation about what you're worried about. If you don't like what's going on and you hate losing money, and most everybody does, but if you don't have the stomach for it, before retirement, do you think you're going to have the stomach for it in retirement? Let's talk that through. 833-368-3680 is our number. 833-368-3680, or again, zinniawealth.com. Click on that gold box. You'll be on your way. All right, I got an article in Bankrate here that calls the Roth IRA the MVP of retirement savings. So let's talk a little bit about the whole MVP thing. I want an MVP working for me in retirement, Cherise.
Well, most people know MVP is most valuable player. So we could talk a little sports, a little bit of faith, and a little finance here if you wanted to. But let's go back to most valuable player. It's always nice to have one of those on the team. And for Go Gators basketball, Walter Clayton Jr. was one of them, right? So those are, the MVPs are a pretty big deal. I was an MVP for a softball team when I was young, but that's about it. So I understand the feeling. It's a good feeling. And we talked about Tim Tebow earlier. So I'm a big fan and advocate of his Tim Tebow Foundation. And so he actually 2 years ago came out with this t-shirt that said MVP. I went, oh, what is that? And it was so cool. I love it. Most valuable person, right? So part of his autism, Down syndrome group, just everybody counts, every single person. And I just love the story behind that. But now we got to kind of fast forward here and talk about finance. So I came up with most valuable plan, right? Okay. So the most valuable plan is what we would call something that protects your income, grows your wealth, and defends your future when it matters the most, right? So MVPs across the board are all over our world in all different segments of our lives. And we want to make sure that there is an MVP and actually a few MVPs built into your plan. And that means, like you said earlier, tax strategy. That is the right amount of money in the stock market and in the right stocks, the right dividends, right amount of money in annuities if we go down that route, a right amount of money in the 1 and 2 year notes out there, the right amount of money in private equity or real estate. So all these are parts and pieces of the MVP plan here at Zinnia Wealth Management. And you have to have that MVP in your portfolio, because earlier we talked about transparency and communication, and education is going to keep you confident. So if you don't have a really good drawn out written MVP in your portfolio and in the offices that you work, then you need to start asking for them, because how else do you have confidence through times that we just had and in the future? I mean, markets can't stay up forever. We're going to have a crash one day.
Yeah.
If anybody doesn't think we're going to lose 30 or 40% one day, then
it's going to happen is what you're saying. Yeah, it does happen. That's what markets do, you know? And I mean, we just went through the NFL draft and we had 3 full days of all these teams trying to find their next MVP. That's basically what they're doing. And they're looking at these people and they're saying, oh, he's got these skills. He's got these things about him that I think that we need to plug in to our system that's going to work and make our system work better. In a way, Charisse, when you choose a financial advisor in your life, you're looking for your next MVP. You're looking for your next most valuable player. And I think that knowing how that person reacts during times like this, if the market's going up like a hockey stick, every financial advisor looks good. But it's times like this that you really see who the MVP is, don't you?
Exactly. And it's just a built-in written plan, a built-in strategy, a non-just basic 60-40 portfolio. You can sprinkle in a 60-40, but you're going to sprinkle in other asset classes from 5 to 6 different legs in your portfolio. If you don't have 5 to 6 things built into your portfolio and you just have a 60-40 portfolio, yeah, you could survive it, but it depends how much money you're going to live on. It depends on how much emotion you can handle and not pull the trigger when you're being emotional. There's so many things that you have to dial into when it comes to that asset allocation, the bucket strategy, the income strategy, the wealth preservation strategy. And you want to make sure that you understand the plan.
Well, there's a lot of different financial products out there that you can use in your retirement. You need to see all of them in front of you to see what's right for you. Now, this article from Bankrate says that the Roth IRA is the MVP of retirement savings. They say they love the after-tax contributions.
Right.
They love the tax-free withdrawals. However, the Roth does have a certain amount of limitations. There are limits on how much you can contribute. There are limits because your money has to sit for 5 years before you can access it. So there are some limitations, some downside. How do you take these limits that are within that Roth IRA and make them that retirement MVP?
You know, it's tough, but there are some strategies. There's always the backdoor Roth, because if there are limits based on how much income you pull in every year. You can't contribute to a Roth at all, but there is a Roth backdoor strategy that you can do if your income's over a certain amount of money. But you're still limited. Here's this number 2 limitation to how much you can put into that Roth. And it's based on W-2 wages. So if you're over 50, you can, do $8,000. If you're under 50, you're basically at $7,000. So you're limited. You're like, well, how do I get that to $1 million? Well, it's nearly impossible, right?
At that rate,
limit.
yeah.
So the catch is this is the other workaround, you could start rolling your IRAs over to a Roth. And even if you're still working, you can do that, by the way. As long as it's a transfer or rollover form, you can transfer IRAs to Roths with 0 penalties. Of course, anytime you put money into a Roth, it's coming from your bank account on average. And so you already paid the taxes on that. But if you're rolling it from an IRA to a Roth, you do have to pay the taxes on the rollover, of course. But trust me, taxes are, a big bang effect.
Yeah.
A ticking time bomb when you retire. And the myth is, you're going to be in a lower tax bracket. I meet very few people that are in a lower tax bracket because of these IRAs that have blossomed so much. So you want to have tax-free income in the future as taxes go up. So that's one of our goals. You want to leave a tax-free inheritance to your heirs so that they're not held with this big tax debt. And, 30 to 40% of your money could possibly just go back to Uncle Sam. So pay it now, especially if you're only in a 15% or 20% or 12% tax bracket. That means more money to your heirs in the future, which grows tax-free. So there's so many things that you could do, but you might be able to do all of them. You might only be able to do one, depending on your age, depending on your income, depending on how much extra cash flow you have. So this is why it's good to work with a financial advisor, because maybe one year you're like, nah, I can't do this year, but hey, maybe this year we can make a plan. And then you can, I call it leapfrogging, change up strategies every 2 years so that you can start building that tax-free bucket.
So one of the things that you have said in the past, I'm reaching back into my mental checklist of things Cherise has told me, and that is this. You said to me that if you have a Roth IRA, that money probably could have a little more risk to it because that might be the last bucket that we access.
Yes, we tap into. So just know when you have a Roth IRA, to get all the interest that it grows, tax-free, you have to be 59 and a half and older, and you have to have it for 5 years. So that's the other thing. But so it's off basically when it comes to your Roth when you're first starting it. But most people won't tap into a Roth till later on. Okay. So that if you don't need these dollars till later on, I'm talking about 10, 15 years, 20 years down the road, then you can have all the risk you want because we always know the stock market comes back. So that financial conventional wisdom, buy and hold, works best in that Roth IRA, believe it or not.
So does that change the philosophy any if you take it out of your 401k and move it over to a Roth? Should there be a different mindset as far as risk is concerned?
Absolutely. A lot of people, when they come in and we do their portfolio x-ray, we notice the Roths are really the most conservative thing out there.
Wow.
Yeah, they're sitting in banks and cash. And what they don't understand is because nobody's educated them is like those are the dollars that will never be a ticking time bomb. They will never be taxed again. So those are the dollars we want to double, triple, and quadruple. And those IRAs, we want them to be more conservative because I don't want that thing to double, triple, and quadruple because that means so much more money out of your pocket to Uncle Sam. It's a wasteful spend, in my opinion. And we'll do the math when you come in because I know people are like, what is she talking about? Why wouldn't I want my 401k and IRA to double, triple, and quadruple? I'll show you the tax burden on the horizon if your accounts do grow that largely in comparison to the Roth strategy.
So that Roth IRA could be the MVP of your retirement portfolio. And in order to figure out how to do that, and I mean, passing the money on to your heirs and doing that without the big tax bill for your spouse or your kids, it really does make a lot of sense, at least to talk through it, doesn't it?
It really does. And there's a lot of MVPs in our portfolios, and it comes with a sprinkling in that Roth strategy. It also comes with your estate plan, making sure your wills and trusts, whether it's a dynasty trust or an irrevocable trust or an income trust, whatever it might be, depending on the season and stage that you're in, is also a part of your MVP. The long-term care plan, that's a whole segment of your MVP, right? The income plan, like what are we living on for the next 30 years? How are we going to maintain our principal? So the strategy built inside of that portfolio is going to be part of the MVP of the overall written comprehensive plan. So there's a lot of MVPs that we have to work on. And those people who are just keying in, most valuable plan, MVP. So
give us a call at Zinnia Wealth and let's sit down and build that MVP retirement plan for you, choosing the right options, the right financial vehicles, the right risk level, having a good tax plan. It's all a part of what we do at Zinnia Wealth. Give us a call. Give us a look on our website, which is zinniawealth.com, ZINNIA wealth.com. You're going to see a gold box there. It says complimentary retirement consultation. Click on that. We're going to ask you some information and just put in, some little contact information there, and our team will reach out to you and start the conversation. Let's see if we can help. You can also call us 833-368-3680. Again, 833-368-3680. All right, so for years, we hear this nonstop. There's a retirement crisis. People are not saving enough. Well, I saw an article just recently that said, you're saving too much. And I was like, what? This is completely different from anything I've heard. There's some new research out there that says that people who have saved $500,000 for retirement, after 20 years, they looked at these people and they said, well, how much of that $500,000 have you spent? In 20 years, the average is $60,000. They have spent $60,000. They have $440 left. They're not spending their money, which means we don't have a saving problem, folks. We have a spending problem.
Yeah.
And this is one of the things that we talk about regularly, and I think we need to drive this home as much as we possibly can. You have saved for 20 and 30 and 40 years for retirement. And when you get there, you need to have the confidence that the money is going to be refilled every month. And a lot of people go into retirement and they don't have that, Cherise.
No, I'm so curious about this person, actually. I'm going to go two ways with this. Number one, if they only spent 60 of their 500, that means they must have a pretty good Social Security check and a pretty darn good pension, right?
Maybe.
That's a possibility. Number two, they have Social Security and they're so petrified of running out of money and of the long-term care issues in the future and funding that. They don't want to be a burden to their kids, that they're afraid to spend their money, which I do hear more than not. So it could be two takes here. So if you have Social Security and a pension, good for you. You probably don't have to spend your money. But I still encourage those people. I run across them all the time that have like 120, 150,000 between combined Social Security and pensions, yet they have, at least $1 million saved. I'm like, well, why aren't you pulling on this money and doing something with it now? Because when you turn 73 or 75, depending on your birth date, you're going to be forced to pull money and pay taxes on it. So why don't we just spread this tax bill over the time period and reinvest it either in a Roth or gifted or stacked away for something else? And I get them thinking, they're like, yeah, you're right, Charisse. I did save all this money. Why aren't we spending it? We didn't work our entire lives to hand this off to our kiddos. And so we are the voice of reasoning here. And there's a lot of ways to spend that money. And so if you're somebody who just has Social Security and you saved $500,000 and you only spent 60, you probably have some fears built into your portfolio. You might be managing your own money. You might have left it at the bank making just a little bit of money, so you're afraid to spend it because you're not watching it grow very fast. And then you might be alone, widower, just single, and you want to make sure that you're not standing on the steps of your children's house with your hat hanging on your hand asking for help. So you might just be saving it for that. But we do have to make some money on it. And there is a way to grow your wealth, your $500,000, and still pull money out to live on. And I will say, when you come in and we do our written income plan, this is serious business. We do not take this lightly. If that is you definitely want to come in and see us because we can help you feel confident spending some of that money and still show you that you're going to have money for care in the future with some of our strategies that we can build in, because we have a lot of long-term care type of ideas between trusts and elder attorneys and other alternatives and avenues. So don't let that stop you, because there is a way. And the only reason why you're not spending your money is nobody has showed you the path, that retirement journey that helps you have really good habits and keep stacking them with confidence, and stacking those travel trips, stacking those gifting strategies, stacking all the things, gardening, working out, whatever those things are in retirement. You should be doing those things. You've worked your butt off. So why are we not having some fun and having a joyful retirement? And it's because it's a fear of running out of money, Randy. Yeah. And until people sit down, park their butts in our seats and sit down with our advisors, they don't have as much confidence. And I will say 9 out of 10 people, I can't believe this, but this is so true. 9 out of 10 people who come in and sit with us, it doesn't matter how much money you have. We see zero confidence in retirement. 9 out of 10. This is no joke.
Isn't that interesting?
And people have pensions and Social Security, and they have a lot of savings. They just don't know how to turn it into an income journey. And so this is what we do. We help build the dream, we show you the journey, and we map it out for you. That now that we're communicating with you, you see the transparency, you see the different strategies, you see your growth growing, you see your income pouring into your bank accounts. That leaves people with uber confidence, and it helps them spend and be confident about it. And that's what you should be doing in your golden years.
And that backs up something. I remember back, we did a story. There was an article I remember about people who have $1 million saved for retirement, and they interviewed them, and they found that they have exactly the same fears as everybody else. And people who've saved $5 million and people who have saved $10 million, they have the same fear of running out of money.
I had a gentleman come in, he had almost $5 million, and he was just living on Social Security because he wasn't traveling. He had a nice house. The debt was paid off. And he went, I'm just afraid to run out of money. I'm like, you have 5. I tried not to laugh, and I did not, just so you all know. But I'm like, I love my job. Because, 3 appointments later, he all of a sudden, he saw the plan. He just had to see it for his eyes. People are visual. They're just visual. And if you don't see the visual, how in the world are you going to know? Because you can't guess. And I know most people, financial planning is not your wheelhouse. So sometimes it's worth finding that advisor that just suits your gut best.
Well, what usually happens is they start seeing their money go up.
Yes.
And so, I mean, you think your money's going down, but then for 2 years you go, holy cow, I've got another $250,000 here. My money's going up. I got to go out and spend something. So you've wasted 2 years of travel, 2 years of fun, 2 years of, doing all these things that you wanted to do when you're healthy in your early years of retirement. So let's sit down and build that income plan to give you the confidence that you're going to spend it, and then we refill the bucket and you go spend again. I mean, it's that simple. Let's talk through it. Give us a call, 833-368-3680, 833-368-3680, or our website, which is zinniawealth.com, ZINNIA wealth.com. Click on that gold button there. It says complimentary retirement consultation. That's exactly what it is. It's a free meeting, sitting down, seeing if we're a good fit and can we help. Again, zinniawealth.com. Now, when we talk about income, there's a lot of different ways to build income in retirement. One of them is annuities, and we talk a lot about that on this show, the good, the bad, the ugly of annuities. And over the last 4 years or so, annuities have been sold at record levels because a lot of people are retiring and they like the idea of that paycheck coming in every single month. So then there's a question. When should I buy an annuity? Should it be 5 years before retirement, 3 years before retirement, right on the edge of retirement? This is Elizabeth O'Brien. She's from Barron's, and her opinion is you should wait.
A good time to buy if you're going for a fixed annuity is right when you need it. In retirement or approaching retirement, you calculate your expenses. You say, okay, I want my essential expenses to be covered by Social Security or an annuity. That's a common thing. So here's how much I need. Let me go buy the annuity. You don't sort of buy it way in advance.
Okay, so I've heard pros and cons on that. Charisse, is it good to buy an annuity 3 years before you retire and let it percolate for a while, or what's the up and the down of all this?
So there's 4 types of annuities, but 2 types I'm a big fan of, and the other 2 types I nix it because of the crazy fees, and you can lose a lot of money in them, and so I'm not a fan of those. So let's talk about the good ones that most people don't hear about. Okay. There's the income annuity, and then there's also a growth annuity. If you say, Charisse, I have Social Security, and I don't have a pension. I would love an extra check to pay all the fixed bills. So I know my Social Security comes in and this check pays all my fixed bills, and the rest of the money I want to invest, and that's my travel plan or whatever plan you wanted to make, right? And so, no, you want that to bake a little bit longer. So the sooner the better. So for example, like one of our companies right now is guaranteeing, I think it's 9.5% every year. You let this thing sit there and bake on the income/private pension plan part of it. So if you don't have a pension, you can get something like that, because when you do get a pension with your employer, all they're doing is they're putting you into an annuity. But the problem is that when you put the money into an annuity with your employer and they give you that check for the rest of your life, when you die, there's nothing left to your beneficiary. So hopefully you did 100% income to spouse, but thereafter, typically after 10 years, nothing goes to even the kiddos. So I am just not a big of a fan of those pensions unless they're going to pay you at least 6% or whatever the lump sum they were going to give you either way. So I do like the ones where you can let it bake for 5 to 10 years before you turn it on. So let's say you're 60, you're retiring. Let's say you have longevity and your parents are still alive and they're in their 90s. And then you say, all right, I might live to my 90s. So let's take $200,000 of my $1 million, put it into this income annuity. It's going to guarantee 9 or 9.5% a year for the next 10 years. We'll turn that income on in 10 years. And in the short run, we'll live on Social Security and all these other investment strategies that are built into the portfolio. Because what you're doing is you're buying income. So buying income, the older you are, the more income you get. So you want it to delay. And let's say you are 65 or 70 now. You could get an annuity that, since you're older, will pay you a higher income than 10 years ago. So there's some strategies built in, but you want the right annuity so that if you die earlier than life than ever expected or intended, money is going to your kiddos. Like the rightful dollars you have saved still goes to your kids. It doesn't go to the insurance company. I do not like that deal. It's a bad deal. No way, Jose, in my office. So we try to encourage people, you need an annuity that has a strong growth factor. So there's not too many companies out there that will allow you to invest in the S&P 500 and get a guaranteed income stream for the rest of your life with a possibility of living 30 years and still having a death benefit to those kids. That's the type of annuity we're talking about. So there's nothing that stands out that sounds bad about that. So the old school annuities, yes, they have a bad name, and for so many purposes. The great generation got them, and then the baby boomers, when they inherited them, there was no money in them to inherit. So yeah, that leaves a bad taste in the baby boomers' mouth. Now, moving forward, they've evolved and changed. But there's only one company in the entire country that has a safe annuity that can never lose. Their fee is only 1%. It's a really great price because most fees are like 3 and 4. You can invest in the S&P 500. You get a 9 or 9.5% roll up on your income value every year until you turn on the income. It is crazy amazing. So I'm a big fan of this, but I'm going to be honest with you. My advisors work with people who are really needing that extra income load. If you don't need the income, so let's just say here's the second type of annuity. Let's say you don't need the income. I already have a pension, or I got a Social Security check, I have real estate, whatever the semantics are. But I do want some safety, and I do want something that doesn't have a fee in the portfolio. I want something that invests in the S&P 500, that makes money when the market goes up, but also doesn't lose money when the market goes down. And so that would be one of the growth annuities. You can call it a fixed index annuity or just an indexed annuity. They have evolved. Robert Shiller was one of the first to recreate an amazing index annuity years ago. They partnered with Athene, and to invest with Robert Shiller, you had to go through the front gates of Athene, right? Robert Shiller's index is not so good anymore. So we are a fan. I'm giving more information I should on radio, but I just want people to know, if you're going to an growth annuity, just stick to the S&P 500, not the S&P Mark 5, not the S&P Volatility Control 6, the straight up S&P. If it has any digits or initials afterwards, say that's junk. We don't want it. So we want a growth annuity that has zero fees. So now you don't have to have as many bonds in your portfolio charging you a 1% fee, because that growth annuity can be your bond replacement. On top of that, we like to sprinkle in the 1 to 2 year notes that can make money potentially when the market goes down and makes money when the market goes up. So sprinkling a little bit of each one of these strategies is important, but I am not a big fan of fees and annuities. So if you get an income annuity that's giving you 9% a year on the income value side and still allowing you to invest on the real account value side in the S&P 500, I'm a fan, as long as you need that income. And you usually do that if you haven't saved enough money, yet you have a big budget in retirement because you have lots of travel plans, right? So again, there's a strategy, and this is the conversation that we have in our office.
Well, the whole topic of annuities is kind of a complex one. The idea of getting income in retirement is something that everybody needs, everybody wants. And to sit down and talk through all the different options out there that are there for you to build income, you want to try to replace that paycheck that you got from your employer. Now you're in charge of your paycheck. So let's look at all the options out there, and if it's an annuity that is interesting to you, let's look at all of them. As Charisse has kind of pointed out here, there's a lot of different kinds, and you want to make sure that whatever you get into is right for you.
And I also want to add, Randy, you do not have to have annuities to work with us. We have plenty of clients that have notes and stock market money. So we're going to show you all these strategies, and then you get to pick and pull what suits your fancy.
We want to make sure everything is available to you that we can show you. And in order to find out what that's all about, give Charisse a call. Take a look at our website. Let's sit down and talk through it. We'll do a complimentary retirement consultation. If you're worried about how you're going to get paid in retirement, well, let's bring that right out, right at the beginning, right on the table. Where am I going to get my money from other than Social Security? Great question. Let's solve it for you. ZinniaWealth.com is our website, ZINNIA Wealth.com. Or you can go to 833-368-3680 and schedule an appointment right there. Well, Charisse, not long ago, we just went through tax day, and right after tax day, you usually do a shredding event.
Yeah.
How did it go this year?
It was great. We have people come, and Staples does all the shredding. We have food, we have prizes, giveaways, and our Zinnia Platinum Club members get an exclusive gift that I get to pick out every year, which is so much fun because I'll get them something that I really wanted. So that was fun. We had the Grilled Cheese Foundation, Miss Sandra came and represented the Grilled Cheese Foundation. She's just the queen of the Grilled Cheese Foundation and all of our fundraising. I love her so much. And we actually, you will not believe this, I'm going to hire them for everything. But we had a food truck here, Brick and Ember wood-fired pizzeria.
Okay.
Oh my gosh, it was so well done. It was beautiful. I was like, for now on, you're hired for all of our gigs. But what was cool is that he lived in corporate. He got fired in 2018, then COVID happened, and he has 11 kids. And so they started this family company. They have 2 trucks now. They do all this catering, like very well done, very professional. They had Italian music. Oh, so right up my alley. So it was a great event. People loved it. And so we'll do it every year in April, like we always have. So
nice.
If you missed us next year, come get your stuff shredded.
There you go. All righty. All right. So one of the things about going through the process of retirement planning is we got to figure out how much you spend per month. And so you're going to get a sheet of some type and you're going to start to figure out, okay, what do I spend on my utility bills? What do I spend for my cable bill? What do I spend for gasoline each month? What do I, and on and on and on it goes. And as you go through the on and on and on, you're going to start to see things like, what do I spend on Netflix? What do I spend on cable? What do I spend on Spotify? What do I spend on health clubs and phones and alarm systems and lawn care and apps and on it goes?
And dentures and teeth and eyeglasses and Botox.
Oh, my gosh.
You name it.
It is death by 1,000 financial cuts. I'm telling you. It's just unbelievable when you go through this process, but you got to do it.
Because the new cappuccino maker, that's $3,000 that I just saw I wanted. I'm sorry. Okay, keep going. Sorry, Andy.
So another part of this that seldom any of us do is to go through our finances and our financial accounts and to try to figure out how much they are costing us. Because, folks, Vanguard, they're good people. Fidelity, good people. Edward Jones, good people. John Hancock, good people. But it's costing. They don't work for free. There's money coming out of your accounts that is going to these places. And Charisse, this is something that you do when you sit down with people is you identify that. So how does that process work? What is the reaction of people when they see is how much is going out? And most importantly, what do you do about it?
Yeah, we take a scalpel to that portfolio. We're the fee doctor, okay? And we're here to doctor up your fees because we are our hunting ground, a stomping ground for retirees, and people from across the country come here to sell stuff, right? Because there's so many retirees in the villages in Ocala and Gainesville. So I want to talk about the 3 types of fees you could see in a portfolio. And this is what I see. So when you come in and do a portfolio x-ray, we're going to analyze the fees. So number 1, we see advisors get paid a commission, and we see the firms get paid an expense ratio, which is an internal fee. So the commission could be 5 to 7% to the advisor. And then we see the internal expenses, what could be another 0.75 to 1.25%. So if you analyze that over, 6-7 years, that's 2% a year. So that's one set of fees. Yeah, like get away from that. It's such a ripoff. The second type of fee we see is there's not a commission, but the advisor charges a 1% fee, and then the custodian, the people where your money sits, is charging an expense ratio fee, which is also an average of 0.75 to 1.25%. So you're still looking at an annual fee of 2%. And then there's the third compensation platform, where there is a commission to the advisor, 5 to 7%, plus there is an annual fee of about 1.5%. And then there's the internal fee to the custodian. So we're looking at like 3.5% a year. So those are astronomical. So what can you expect when you come to Zinnia? Well, not that. Our goal is to lower your fees because over 20 years in this industry, I have learned people do not want to pay me. So if they don't want to pay me, how do I win them over? Well, I lower my fee, right? So for example, say you have $1 million, and this is how our portfolios can break down. Everybody's household is a little different, but we put $500,000 into typically something that has 0 fee. Wow. Then we put like $200,000 into something that has a 0.5% fee, and then $300,000 into like a 1 or 1.5% fee. But there's advisors out there who will take your $1 million and you will be charged fully 2%. And you won't know that until we put that scalpel to your portfolio to show it to you. So how can we afford to do this? Well, we are Zinnia Wealth Management. We don't have white ivory towers all over the United States, so our fee structures can be much lower. We're not working for a big broker or a bank. And so there's not a bunch of people that need to be paid in between, because everybody's got to be paid, right? The VPs, the internals, the CFAs, the advisors, and then they still got to pay the lights, right? And the rentals. So most fiduciary advisory firms like ours, we can keep fees down because we don't have all that red tape and all those extra costs. So that's a nice thing. Some portfolios that we'll do, maybe they'll be $300,000. Maybe you want active management. You like, Sharice, I want day trading. I want quarterly trading. I want this, that, or the other. So when you do get charged a fee, let's say you want a full-blown portfolio done the right way, you could have your $1 million. We could have $600,000 being charged 1.5% or 1%. That's if you really want an active managed account. And I feel like it's fair, Randy, that I tell people this because we are actually doing something. We made a trade, 2 trades last month. Every quarter we make trades in a couple of other portfolios. And on our really very day trading active portfolio, we'll trade once a month. So we're getting paid a lower fee, yet we're doing more than most advisors across the country. And on top of that, the other advisors across the country, they're not going to do your tax plan. We do that at no cost. They're not going to help you with Medicare. They're like a deer in the headlights when you ask a question. They're not going to tell you when to take Social Security. They're not going to create your income plan. And most of them aren't even going to introduce you to their CPAs and their estate planning attorneys to help you build those other parts of your MVP plan.
I think you hit it right there at the end, and that was, what services are you getting for what you're paying? Mm-hmm. And if you have to dig your way out of 3% or 5% of fees to try to make 7 or 8%, now you've got to make 13%. And that is not easy in this stock market, certainly in the environment that we're in right now. So look at services. I think that is the key thing. Sharice doesn't make money on giving you options for Social Security or Medicare. That's all part of our service at Zinnia Wealth. Give us a call. Let's show you what we can do for you in the retirement planning space. Give us a call. Give us a look on our website, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Let's talk through what your needs are and concerns are. Or call us, 833-368-3680. Sharice, that is all the time we have for today. I'll give you the last word.
Oh, time flies by, doesn't it, Randy? Well, thanks so much, you guys, for tuning in. It's been a busy radio show. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.